Hello, I am Carlo Bustos, Educational Programs Leader at Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Best Practices in Debt Compliance and a Case Study. One of the least understood and underestimated financial risks a company faces is its covenant violation risk. A covenant violation can cost millions in additional interest and fees, cause a financial restatement, and a material SOX deficiency citation, and lose the CEO and the board's confidence in the CEO or CFO and the treasurer. This webinar will discuss best practices in debt compliance and illustrate one company's experience with upgrading their compliance process for 5 debt agreements totaling over $2 billion, including the internal challenges and implementation hurdles. Just a few housekeeping notes before we do get started. I'd like to welcome everyone back to Proformative. If this is your first time to Proformative, we are the largest growing online community of finance, treasury, and accounting related professionals. We are ad-free, noise-free community where we encourage and expect peer-to-peer collaboration. Check it out at proformative.com. And now some event notes before we do get started. The link to today's presentation and recording will be emailed to you within 24 hours post the webinar, as well as the presentation is currently on proformative.com/resources if you'd like to download and follow along. For those of you who are attending for CPE credits, you will need to answer all 3 polling questions during the event and should have pre-registered for it. For any questions around CPE credits, please contact Chris Brower at proformative.com. We encourage everyone to ask questions throughout the webinar. We will get to as many questions as we can. Utilizing your questions box within your GoToWebinar panel will allow us to view all of your questions and get to all of them within the time frame that we have. For any reason, if we do not, we will work with the speakers to answer your questions directly after the webinar. And lastly, you'll be asked to take a brief survey regarding today's webinar at the end. We will greatly appreciate your feedback regarding our event today, and as long as we continue to drive our content, we look to further improve our content to you and appreciate any feedback you may have. And just some brief learning objectives before we do get started. After participating in today's event, you will be able to determine the overlooked and underestimated risks of a covenant violation, define key elements of best practice debt compliance policies, and understand the benefits of an automated debt compliance process. So let's get started. It's a great pleasure to introduce both speakers. We are joined today by Jeff Wallace, Managing Director and Co-founder of Debt Compliance Services. Jeff is the co-founder of Debt Compliance Services with Jim Simpson, founded in 2009. Debt Compliance Services is the only firm providing web-based automated debt compliance services. He also founded Greenwich Treasury Advisors LLC in 1992. His corporate experience includes positions as Vice President, International Treasury at American Express, Assistant Treasurer at both Dun & Bradstreet and at Seagram. Jeff is a CPA, and he started his career with Price Waterhouse. And Jim Simpson, he's the Managing Director and co-founding of Debt Compliance Services. He has also co-founded Corporate Finance Solutions back in 2002. In his 35-year career, he has led and or advised on over $4 billion in convertibles, high-yield bonds, revolvers, term loans, and ABLs. His corporate career includes being CFO of Moore Medical, a publicly traded company with over $300 million in sales, and C.S. Brooks, a privately held business with over $200 million in sales. And he was also the treasurer of Sandoz USA, which is now Novartis. Jeff will be walking us through the first portion of our presentation today, followed by Jim, and we encourage everyone to continuously ask questions as we will get to as many of them during today's session. Jeff, the floor is yours.
Well, thank you. We're going to talk about misestimated technical and hard default risk and talk about how default can be catastrophic. Jim will then take up the presentation and talk about best practices in debt compliance and discuss a, a client case study. So let's move on to the risk of covenant compliance. There are about 4 common covenant fallacies that can put a company at risk. The biggest one is that covenants are found only in the affirmative and negative sections of the agreements. And usually, a senior credit agreement can have 80 covenants. And you'll find that about 20% are sprinkled throughout the agreement. Another fallacy is that real covenants are limited to financial performance, in other words, the covenant ratios, the prohibitions against additional debt or liens, and making sure that you give your financial statements on time. But it turns out of the 80 covenants, about a good 80%, maybe even more, are the non-financial covenants, which is where most of the mistakes are made and which can trip you over. Another common fallacy is that all I have to do is worry about my senior credit facility because that has all the most restrictive covenants. Well, the problem is that the other agreements will often have covenants that are unique to that type of agreement because you may have an ABL or a convertible or a long-term note. And these other agreements may be more restrictive because the agreement was written earlier under different and perhaps more adverse credit conditions. And then finally, the biggest fallacy is that the lenders will forgive technical defaults. And the issue is this, is that you don't want to put your career on the mercy of bankers. A default is a default, which provides the lenders with the options of exacting penalties or calling the credit. And of course, there's a lot of people lending you money, hedge funds, mutual funds, who aren't interested in a long-term relationship with you, but are definitely interested in getting as much money from you as they can. Talking about the non-financial covenant risk that companies have, you can divide them up into performance failures, notification failures, and taking prohibitive actions. And on the performance side, mandatory prepayments can trip people up. There can be mandatory interest rate hedging. You have a new subsidiary that you need to do the required documentation for. Sometimes there's requirement that you need to register your debt with a certain time limit with the SEC. And of course, you've got things like payments and ratios. On the notification failures, you can have a myriad of things related to things like asset sales, environmental events, ERISA events, MAC issues, union strikes, litigation, losses, change in material contracts. And then finally, there's taking prohibitive actions. And of course, most people think about their permitted baskets, but it could be related party transactions, derivative transactions, your classic change of control, allowing insurance to lapse. And all these things can be listed in your debt agreement, and you need to know what they are. S&P every year does a default study of the last 30 years. And 2 weeks ago, they issued their 2012 study. And so it was dealing with default rates from 1982 to 2012. And what they've determined is that if you're rated, say, BB, within 5 years of being rated, 9.2% of the BBs will be in default. And then they've also done a study of what they call transitions. And they say that within 3 years, about 44% of the BBs will have lower ratings. In other words, they'll be single B or worse, whereas only about 12% will have ratings with higher ratings in 3 years. And for Bs, it's worse with the 5-year default rate of 21% for single Bs. About half of them will end up with lower ratings. And again, only about 11% will end up with higher ratings. And so this is rather sobering information about default risk, and the fact that if you end up with lower ratings, that means everything in your debt agreement is under stress. Now, they define a default to be a missed required payment, a distressed debt restructuring, or a bankruptcy filing, which is what we would call a hard default. Then the issue is what is the risk of a technical default that you can really remedy? And we think that if hard defaults are, if the Bs are likely, if 21% of the Bs are likely to have a hard default in 5 years, a technical default has got to be at least as common. Now, the other fact that comes out of the S&P data is the obvious one, that default risk increases over time. And in this chart, we see double Bs and single Bs. And on the left-hand side, we see that relatively small first-year defaults. In fact, almost an insignificant number of defaults of double Bs in the year one, but a fair amount of almost 20% in downgrades. And as we move on to 3 years, 5 years, and 7 years, the risks of default increased substantially, and also the risk of a credit downgrade increased substantially. And the conclusion that we draw from this is that default risk is a long-term risk. It increases over time, and often we think that people with relatively weak compliance practices are devising or thinking that their practices are appropriate because they're thinking about the first-year risk. And basically, no treasurer borrows and no banker really lends expecting a first-year default. But if you determine the adequacy of your compliance practices based upon your first-year risk, you really are at risk as you move into years 3, 5, and 7. And compounding the increasing out-year risk, in years 3 and 5, you might well have new compliance staff who were not involved in the original negotiations, never were given time to fully understand the covenant complexities, and possibly following a compliance process appropriate for the low first-year risk. So when the company is at most at risk, you have basically a bunch of rookies managing the compliance, and that increases your risk. We did a study with the AFP just recently that we're in the process of evaluating, and we were able to get some preliminary results from it. And we asked, we had 400 people participate in this AFP study, which we did in collaboration with them. And it was done last fall. And we asked them what was their risk of a hard default. And we see some very interesting things that, and then we compared their estimate of the hard default risk with the S&P study that we just showed you. And we see that the investment grade companies come up with a higher estimate of their risk of default versus what actually happens according to S&P. And we think that part of the explanation for this is that the investment grade companies, one of their common corporate imperative for an investment grade company is to keep their investment grade rating. So perhaps they're concerned about that, and possibly they're going to have a little bit more in the way of compliance practices to maintain their investment grade rating. Now, when we start going down to the non-investment grades, the double Bs and Bs, we really see a dramatic underestimate. So we see the double Bs estimate, a 5% average risk of default versus the actual of 9.2. And then the single Bs think that their risk of default is less than what the double Bs think and is about 20% of what the real risk is. And then the triple Cs and so forth significantly underestimate their risk. And you have to ask yourself, what's going on here? And we think that this low estimate of risk is perhaps due to their admittedly low first-year risk that you saw in the preceding slides. We also think that there's what we call the Lake Wobegon effect, which is the Prairie Home Companion, a mythical town in Minnesota where all the children are above average. Maybe the treasurers of these companies think that their company is always going to be above average too. So this is a real key thing that we think that the non-investment grade companies should think about, that they are underestimating their default risk, and as a result may not be putting in the sufficient amount of compliance practices that they need.
We're at our first polling question of the 3 polling questions we have for our event today. So I'm going to launch this, and everyone in the audience should be seeing this momentarily. If you are attending today's session for CPE credits, you must take all 3 polling questions to receive full credit. So we urge all participants to answer the polling question, as it is statistical in nature, and if we do have enough time at the end, we will share the results and get Jeff and Jim's feedback on it. At this time, I also want to remind everyone and encourage everyone to ask questions in your questions box within your GoToWebinar panel to utilize throughout the session or during our general Q&A session. And I'll give everyone about another 5 seconds or so before I close this up and we move on with our webinar. Now, Jeff, before we move on to our next topic, which I know you will be going through kind of defaults and best practices, we did have a question from the audience. I'm going to rephrase it a little bit just to keep the anonymity on it. But we are a business and we have covenant-lite agreements with our bank. So why do we have to care about compliance?
Well, covenant-lite is a great marketing phrase that the banks love to use. And it technically means, of course, that you have very few in the way of financial ratios, and maybe less than usual in the way of permitted baskets. But the issue is A, are there trigger events that can all of a sudden spring up and restore financial covenant ratio requirements? And equally important, covenant-lite doesn't mean that you have no non-financial covenants. That whole list of that slide on non-financial covenants probably still is in effect. So covenant-lite means ratio-lite. It doesn't mean I have minimal covenants. And that's a big mistake that companies can make. There's more to life than just meeting covenant ratios with your debt agreements.
Great, thanks for that, Jeff. And just keeping in motion with our event, I will proceed to the next slide.
Okay. Well, default can be catastrophic. And of course, everyone knows that a default could put you into bankruptcy. And the issue is that a default it becomes a slippery slope, because as soon as you find out that you have a covenant violation, you're going to have to take a look at your agreement and see whether you're going to have to report it immediately to the lenders or report it at quarter end. Because if you don't report it, you're basically committing fraud. And then you have to, and so what are the consequences of having even a technical default that you can remedy? Is there going to be public disclosure? Well, it could crater your company's stock price. It definitely is going to have some reputation hurt. Will you lose access to credit with cascading cross defaults? Probably yes. Will there be business disruption, customer, vendor, and employee concerns? You significantly run the risk of incurring millions in penalty, interest, waiver fees, legal, and audit fees. Part of the issue is, well, what happens if you discover a covenant violation and you go back and check and find out that it's been operative for the last 2 quarters? In other words, you've been in violation for the last 2 quarters. Well, all of a sudden you now could be talking significant penalty interest. Typically it's 2% on your borrowings for 2 quarters. Do you think the banks are going to give up millions of dollars just because you're a good lunch companion? And of course, depending upon your situations and how well you can negotiate things, you may have to rewrite your credit agreement and incur significant additional borrowing costs and incur onerous new covenants. GAAP is very unforgiving about any type of covenant violation, no matter how small, because if you have a covenant violation that's uncured at the financial statement date, you have to report that debt as short-term because the bankers could call it. And if you're a publicly held company, you might be cited for a material SOX weakness because you've misstated your financial statements. And if things really go to pot, there's going to substantially divert management time to dealing with the myriad of fires that come up from this instead of running the business. And of course, it's always finance's fault when you break a covenant, and even if it isn't true. And you're going to lose credibility with the CEO and the board. What we find interesting is that debt compliance is potentially a catastrophic risk. And there are a lot of potentially catastrophic risks that a company faces. You could have property damage, a plant fire. You could have liability torts like shareholder lawsuits. Your IT infrastructure could go down. Financial misrepresentation. Regulatory compliance like a Foreign Corrupt Practices Act violation. And what do people do? Well, they get insurance and they take preventive actions. You might have backup IT capabilities. And you probably have a lot of quarterly questionnaires regarding things like regulatory compliance, financial misrepresentation, and property damage. But when we take a look at funding availability and a covenant violation, typically what we see is a minimal investment in people and training with no questionnaires. And yet these risks are a lot less than the 18% risk that we see for double Bs. And we come up with the 18% because we've got the 9% that S&P says is the hard default rate, and 9% is what we think is the minimum for the technical default. And yet the cost of implementing an automated best practice process is really a fraction of a basis point of the debt, a fraction of the financing arrangement costs, and a fraction of the insurance premiums that you're paying for the other catastrophic risks. So this is another area where we see we've shown how companies can underestimate their risks, and as a result, they're not making the same investment in preventing it or mitigating it that they could. So I'm now going to switch over to Jim, and Jim's going to start talking about best practices in debt compliance. What are the things that you should be doing to better manage your debt compliance risk? Jim?
Okay, Jeff, thank you. And thank you for the lead up on that. And what you've just heard from Jeff is really a great assessment on what are the issues that companies face. And these are issues that, as Jeff has been showing, increase over time. Now, how do we deal with them? And the first thing to do is, and what we've been doing over the last several years, is to identify best practices where companies can adopt these practices and better manage this risk. So part of this is, a couple of years ago, we did a survey of 192 companies. And it was, as you can see in the slide, it was a represented universe all the way from A's down to triple C's, and fairly well, certainly through the, fairly well dispersed. We asked these companies to rate their debt compliance process that they used. And we wanted them to do this on a 1 to 5 scale, where 1 is excellent and 5 is very poor. And the average of all the responses, as you'll see, is 2.32, which is about average. And then we use these ratings to evaluate the assessment of these companies, and then to identify the effectiveness of 9 major compliance processes. These practices here are practices that certainly were identified in our survey, but also ones that we have come across in talking with companies and talking with clients over the last several years. So the practices are a debt compliance policy, or not a policy but written procedures, a comprehensive covenant checklist, and then as an alternative to that, there could be a list of major covenants, but it's not comprehensive, marked up debt agreements, questionnaires, calendar of due dates, and a quarterly analysis of possible and actual compliance exceptions, and board review. What we'll find here is this is a chart that shows how, in a few practice areas, how these companies rated themselves. And if we take just start at the top left-hand side, the one with the best rating of a 1.69, which is a very good rating, these companies use 5 to 6 compliance practices of the 9 listed. There are only 9% of the companies that use that. And only 21% had a debt compliance policy. And with those companies that had a debt compliance process, they also rated themselves very highly at a 1.9. Now, 4 to 6 practices is, including a policy and a board review, is at a 1.64. Now, if we go to the other side of this chart and we look at, 0 to 2 compliance processes, no compliance policy, no board review, no comprehensive list, and what we find is that there is a significant statistical difference here, and the ratings here are quite poor. So the laissez-faire attitude of only dealing with 1 or 2 of these practices, with not having a compliance policy, with not having a comprehensive list, and so on, really is not the best way to approach this. Whereas having a full practice of using these other items that we've identified is. Okay, so let's talk about this, for example. We'll talk about this from, and we're going to identify 5 objectives. First, the first objective for any company is you need to understand your debt agreement and its requirements. There's nothing more important, because you can't manage that unless you know it. And certainly that means reading it and reading it again, but it also means from that developing a comprehensive covenant checklist. And when we talk about a checklist, we're talking about anything that is in the document that says the borrower will do this. We don't care how insignificant that is, because anything where they have to do something is a requirement. It also includes doing a very thorough review of the various permitted basket items that are included, because this can be a big Achilles heel where companies do not even track their permitted baskets. Modeling of covenant ratios and stress testing them is also required. And a due date of calendar of deliverable and fees is also a best practice. Now, once we develop this the understanding of the covenants, we need to integrate these covenants into the company's operations and strategic planning. So it's not enough for just Treasury to know this. you need to disseminate this information throughout the company, because there are people throughout the company that can impact compliance. So where does this, yes?
So before you move on, just something on your first objective. Say a company has a few different agreements. Wouldn't they want to just look at their senior most agreement, which typically has the most restrictive covenants, and that would hold priority, or should they be doing a thorough review of all and from senior to least senior agreement?
They should be doing a checklist of all agreements. Because as Jeff mentioned just a little while ago, where you could make some argument that the senior most agreement has the lion's share of the most restrictive requirements, they do not contain all of them. And as a matter of fact, I dealt with a client a number of years ago where they had a default, and the default was in a junior agreement. And the default was it was a technical default, and because it had been outstanding for several quarters, it created an enormous problem. There had been nothing wrong with the senior most agreement, it was the junior. Okay, so moving on the integration, the first thing that you need is you need a debt compliance policy which assigns responsibilities throughout the company. And you need to identify a compliance team. Now, a compliance team is not just 3 or 4 members from Treasury or 3 or 4 members from Treasury and a legal person. It includes people from Treasury, legal, controllers, and anybody else that would have a vested interest. It is also important to assign subject matter experts, the SMEs, and these are people throughout the company where their area of responsibility could impact compliance. It requires training of these people, both of the compliance members and the subject matter experts, as to their responsibilities. And it's for significant permitted basket risk to implement a hard and fast approval procedures for permitted basket items. And we have seen a number of clients where in the mandatory prepayment, or in a permitted basket item, I should say, they weren't tracking it, and then all of a sudden it came up to bite them. Okay, now you need to determine efficiently and accurately on a quarterly basis how are you complying. And that means you need to review covenant by covenant the comprehensive checklist. You need to determine the financial covenant ratios and the permitted basket amounts. SMEs need to complete questionnaires, preferably web-based, on the covenants that they are responsible for, and with their responses reviewed by their managers. Then the company needs, and the people within Treasury or wherever, needs to develop an exception report analysis of all the potential covenant issues, no matter how small. Now, some of these covenant issues that are going to be raised are going to be, as I mentioned, insignificant or of no real dire value or dire consequences to the company, but you need to understand them all. And then you need to ensure that all deliverables and fees have been sent on time, including the quarterly officer's certificate.
Jim, one quick question before we do move on. Can
Sure.
you give us examples on the permitted basket items?
Well, the permitted basket items, for example, in the negative covenants, there is a restriction where a company is told that they cannot have any additional indebtedness except for a laundry list of items that are permitted. And in this laundry list, there's a few that have a number value attached to them. So they may come in and say that you could have leases, but only up to $25 million. And so now it is very important that if you do have leases in your company, you need to track the value of those leases versus that permitted basket. That answer it, Carlo?
It does, and before, and we're just getting a couple questions on this particular best practice area. So before we move on, one more. Can you define what subject matter expert, when you were kind of mentioning them, and provide examples of their roles they play in when they're interacting with Treasury and finance?
Well, subject matter experts can be either at the corporate headquarters, for example, like somebody in HR could be a subject matter expert, especially with questions vis-a-vis ERISA, or they could be people out in the field like a division or a business unit controller, CFO, or a business unit CEO. And those are people that have a direct impact because all of those people are doing things in their areas of responsibility that can impact the compliance with the debt agreement. And there was an example of a subsidiary of a client of ours who had a French subsidiary, and they went out and sold some assets, and that was not allowed without notice. Well, that notice wasn't provided. And so they had a lot of talking to do with the banks and so on. So there are a lot of people outside of Treasury, and so when we say subject matter experts, that's what we're talking about.
Great. Thanks for that, Jim.
Okay. Now we have, well, two objectives we'll talk about right here. Managing existing and potential covenant issues to mitigate the risk of future covenant violations, and then to proactively manage senior management, the lenders, and so on. So the best practices here, with regard to financial covenant ratios, it is forecasting and stress testing. We have dealt with clients that have done a very good job of this, and they know several quarters ahead of time that they may have an issue with a particular ratio, and they go to their financial, their lenders and so on and say, look, we're looking out 6 months or 9 months from now, and there may be an issue. I don't know for sure, but we ought to start thinking about that. And that's a much easier discussion than 2 weeks before closing of a particular quarter or year end saying, oh, we are in trouble. It also it means that you need to forecast permitted basket items against limits and establish approval processes. It is required by policy that SMEs report prospective covenant issues at all times, not just at quarter end, and that the compliance team monitors and manages the existing and potential issues in the exception report, and that the treasurer discusses these significant possible future covenant issues with senior management and lenders. It is all about here and keeping people informed. And because when we keep people informed, especially either senior management or lenders or whomever, the confidence that they have in you increases dramatically, and it makes it a much easier discussion when things happen, and things do happen. There's no way to prevent things from happening 100%.
And Jim, sorry, before we do move on,
sure.
Another question from the audience here. When should external auditors be included in the debt compliance reporting process, not only to support and obviously identify, but to assure the year-end auditor certificate is confirmed? So when should the external auditor be included in the process?
Well, that is a great question, and the person that asked that is a terrific question. Unfortunately, what we have observed, and what I have observed in my, when I was a CFO and treasurer and so on, is that the involvement of auditors in this process has not been very big. In a number of debt agreements, you will find language in the reporting section of that agreement which says that the auditors will issue a letter to the lenders saying that nothing came to their attention during the course of their audit that would lead them to believe that there is a default. The problem with that is what is the auditor doing to give themselves comfort that that is true? And my experience has been that the auditors up to recently have not done as much as they should, and in many cases they rely upon a rep letter from the CFO saying that that there is no default in any of the covenants, and therefore auditors have not been very involved in any of these processes. I would be interested if anybody in the audience here has a different experience from what I've been observing, and I'm sure there are some that have taken a more active role, but I would be interested in hearing from anybody who has noticed that.
Great, thanks, Jim. I appreciate those insights, and at this point it takes us to our second of 3 polling questions for today's webinar. I will be launching this, and everyone should be seeing this momentarily on your screens. Just want to continue to remind everyone who is attending today's webinar, if you would like to receive full CPE credit, you will need to answer all 3 polling questions. And at this time, I would like to continue to encourage all of our audience members to utilize the questions box in your GoToWebinar panel to continue to ask Q&A. We will leave some for the general Q&A session, but if there's something that piques your interest when Jim and Jeff are going through their slides, please don't hesitate, and we will try to get to as many as we can. And I will leave this polling question here up for another few seconds here, and we will go ahead and move on.
We're going to talk about one of our clients, and we'll go through this relatively quickly. But this company is a good-sized company rated BB, and they've had a number of acquisitions which have increased the debt significantly. They have 5 major debt agreements. They have a revolver, Term A, Term B, 3 senior notes, and a convertible. And they also are looking to maintain the company's access to capital by properly and proactively managing its debt compliance. And this was, when this company came to us, they had had a minor scare where they thought they had violated a covenant, and the treasurer became so concerned with that, and it was a technical covenant. It was not a ratio or anything like that. And that's what led them to focus their attention on improving a manual compliance process. What we see here is they did engage us, and they wanted to use our automated web-based services. And we went in and identified approximately 300 covenants in these 5 agreements. And we vetted these covenants with their treasury and legal department and made sure that they were real covenants and that we had not missed anything. And the key thing there, from a point of view before they started this process, when they thought that they only had about 50 or 60 covenants, to get to a number of 300 was quite a lot. Now, not to scare everybody on this, if you take a look at how it would have been broken down, the revolver had a greater percentage than anything, on the order of about 100 covenants. It was a very complicated agreement, and the senior notes had about 40 to 50 each. So, so it was somewhat manageable from that side. And then, in order to get information from the subject matter experts, they wanted to do the web-based questionnaire, and we wrote over 600 questions about the compliance with those covenants. And the reason that there were so many questions for those covenants is that as everybody in the audience probably is very aware, a lot of these covenants are very convoluted and contain many different aspects. So you might have one covenant, and it might have 5 or 6 questions that have to be asked. And asking a question that would encompass all 5 of those would really miss the point. The questions were done in yes/no format, and if it was a negative response, and I'll put the word negative in quotes, it required explanations. And to make it usable, we had pop-up boxes that provided definitions of the defined terms because they had to be legally precise. And the questions asked about the current quarter and prospective compliance. The client, in order to get that questionnaire out, they identified 30 respondents. And these respondents were in Treasury, legal, controllers, other divisional operations, other corporate departments, procurement, and so on. So there were a lot of different respondents, and these respondents were all around the world. The client also developed, or we developed, web questionnaires for these 30 people, and when you ask these people questions, that 600 questions became 900 because there were some questions that had to be asked multiple times. And finally, we developed a very thorough and comparative calendar of all regularly required deliverables for all 5 agreements. So now what's happened? Using the web questionnaire process, they have a quarterly process where they review respondents for personnel changes. They open up questionnaires and allow 5 days to respond. The responses come in on a real-time basis, and so they update reports on a real-time basis. And these reports, reporting tools, they validate responses, analyze exceptions, and they're used in a quarterly meeting with the treasurer, CFO, and CLO. So what you have here is in one location, you have the ability to manage all of your compliance needs. And then outside of DCS, they do their own calculation and stress testing of covenant ratios. They calculate their permitted baskets, and then they review with the CFO who signs the certification. And what they have at the end of the day is they have an audit trail that identifies and shows how different issues were resolved. And that gives them a lot of comfort, especially when they go to the CFO and ask them to sign a document that, if it is proven wrong, can be, as we've mentioned before, very catastrophic. And the benefits to this client is that it provides a clear corporate overview on a quarterly basis with minimal effort that far exceeds everything that an individual or team could do. It assigns responsibility to key business stakeholders, making them understand or having them understand debt obligations and substantially minimizing the risk that a business decision that is good could inadvertently breach a covenant. It's permanent, it's repeatable, and it can be accurately transferred to new staff. So getting to what Jeff talked about earlier, where the occurrence of default can grow over time, this should prevent that from going up as quickly, if at all. And it helps you proactively manage your lenders and avoid surprising them, which is a big no-no. And then Treasury fulfills its responsibility to fund the company's growth strategy at the lowest possible cost. So moving ahead to the next slide, I'll take a couple minutes and talk about conclusions, and then we'll finish up with any more questions and answers. So as with any of our Treasury activities that any of us face, developing an appropriate debt compliance process requires balancing risk versus costs. But it should be noted that for less than investment grade companies, we've shown that these risks are too great to lead to an incomplete and manual process. These risks are relatively small in the first year, but they do grow. And if you have new staff, the knowledge that is lost can be very problematic. The best practices that we've listed and discussed are common sense requirements. The cost is spending the time to set up the process. And once it's complete, the process should run smoothly and efficiently. And that the benefits of these practices are not only in completing this quarter thoroughly and efficiently, but in using the information gained to manage the debt compliance risks in future quarters. So just moving on to one other thing, and then we'll open it up. As Jeff mentioned, we are just finishing up a survey with the AFP. It's a benchmarking survey, and it's a 12 to 15-minute survey. And we'd like to open it up to any of the people on this call to fill out that survey with no obligation and submit it using the site that you see below. And you'll get copies of this so you can use it. I think you'll find that the results can be very eye-opening. So with that, I'm going to turn it back to Carlo.
Thank you, Jim and Jeff, for your time. Just want to briefly make the audience aware of who Debt Compliance Services is. Here you can see that now they're in their 5th year, and it's co-owned by Greenwich Treasury Advisors and Corporate Finance Solutions, both owned and funded by, founded by Jeff and Jim. And we kind of went through their bios briefly in the beginning. They also, and thank you, gentlemen, for your time and your insights, they've also shared some recent articles and publications to help any of our audience members if you feel that you have still further questions or would like to get better educated in this particular topic area. They have shared some of these, and like Jim had mentioned, this presentation will be made available to all attendees. So with the interest of time, gentlemen, I have a few questions that are in. I can only take one just because we are close to the top of the hour. And as everyone knows who's in Treasury, Finance, or Accounting, we are getting to a month end, but as well as a quarter end and possibly a fiscal year end for a lot of companies. So I want to keep everyone on time and on schedule. So with that, I want to take one question and from the audience. It's around when you guys were talking through the questionnaires, Jim, throughout the corporate fiscal year, how frequently should those questionnaires be reissued to the respondents for feedback? And I'd love your thoughts on that.
Well, what I'm going to do is I'm going to pass this. Jeff does a lot of work on the questionnaires, so I'm going to pass this over to Jeff, and he can talk about that.
Well, the answer is that you want to have, at the minimum, a quarterly questionnaire process. And we've found that with the very large companies, and we're talking Fortune 50 companies, that sometimes they will have abbreviated versions of the quarterly questionnaire and do it monthly. And they're very process-oriented, and they want to find out within the quarter whether there's any potential problems. Because really, at the end of the day, if you discover a covenant violation after quarter end, there's not much you can do about it except report it to the lenders and deal with the consequences. However, for the non-Fortune 50, it's a quarterly questionnaire process.
Great, thank you, Jeff. And like I had mentioned, I apologize to the audience members. We did not get a chance to get to all of your questions, but we will work with both Jeff and Jim to respond to those questions as quickly as possible post the event. With the interest of time, just want to get through a few more housekeeping slides. within today's event. I definitely want to take this time to thank both Jeff and Jim for taking the time out of their days to sit down with us and really discuss some of the debt compliance aspects that some may have been familiar with and some may have not. Really appreciate it, gentlemen. The insights and the knowledge you guys have shared with us today was great. So thank you so much for that. One last slide before we do kick off our last polling question of the day. You will be prompted at the end of the webinar to take a short survey once this concludes, and we greatly appreciate your feedback regarding this event so we can continue to drive the content and the value you receive through Proformative. We also would encourage and love for you all to take the conversation and discussion onto Proformative.com to continue to ask questions and offer in insights to your peers, as well as leveraging Jim and Jeff's expertise. And if you have any questions around the CPE credits, please contact Chris Brower at Proformative.com. And with that, everyone, I will launch today's third and final polling question. You all should be seeing this momentarily. We will work with the speakers to get to your questions that we did not get to today. At the end of this webinar, you will have the survey, and that actually will give you an opportunity to ask for an introduction to both Jeff and Jim with the click of a mouse. We greatly appreciate everyone's time on today's webinar and the questions asked. Jeff and Jim, thank you again. And we look forward to seeing everyone at another Proformative event or online at Proformative.com. Have a great rest of the day, folks. Enjoy your Easter weekend, and we look forward to seeing you guys again. Thank you, and goodbye.